The curriculum talks about tools and strategies to minimize risk at the end of the day. We're looking at diversification. So, with respect to single stock positions, the following, there are 3 categories, 1, 2, and the third on the next slide. So, the first category is to look at derivatives to hedge. So, we have hedge, that's the key word. So, we will be using exchange traded options or over the counter derivatives. Derivatives will be in the form of options, forwards, and swaps. The other strategy is to monetize the position, and monetization can be carried out via margin loans, via recourse and non-recourse debt. What is non-recourse debt? Non-recourse debt is where you don't have access to the borrower's other assets. So the liability is limited to the project that we're talking about. Okay. We also have fixed and floating debt, and then we have loans embedded within a derivative. We will study what we call is a prepaid variable forward. The other monetization strategy are short sales against the box. We have restricted stock sales. We have public capital market transactions, which is debt exchangeable for common offerings. You may have heard about convertible bonds. Okay, this could be one of the strategies. We also have Rule 105B1 plan and blind trust. This is specific to the US. And we have exchange funds, which is essentially pooling of concentrated holdings. So let's go through them. Before we actually get into them, let's look at the first and foremost thing. I think the theme of the curriculum from Reading 11 has been very focused towards tax. And I think that focus is getting more and more complicated here. That we have to make sure that when we're looking at publicly traded common shares, the instruments evolve. Advisors use a host of strategies to make sure that their portfolio is tax efficient. The point here is that tax authorities actually lag the people who structure these trades. So a trade is made and there is no tax event from that. So once the tax authorities know about that trade, then they devise a strategy to tax it. And then the strategists will make new tax strategies which will be tax efficient. So the idea, the final point here is that when we're talking about portfolio management, we know that advisors need to come up with new strategies, since more often than not, the strategies in the past have been brought into the tax net. Okay. Now, what we will discuss also are non-tax considerations. So we discussed that there is, well, we've spoken about credit risk. What can be counterparty credit risk? Counterparty credit risk can be a resultant of over-the-counter transaction, whereby there are two people actually doing a transaction. So in the event that there is a trade and you want early termination, and there is a counterparty which is not ready to terminate, you could have a credit default, credit event. In the event that you're talking about exchange trade instruments, that means there is a market. What is the credit risk possibility here? It's lower. Why do we say that? Fundamental point is there is a clearing house involved. Okay? Because it's a market. So there are people underwriting this particular trade. Does that mean there is no credit risk? Absolutely not. There is credit risk, but it's minimized. Okay? It's also important that what is the expiration of the option or the trade. That's very important. Do you want to, does the counterparty have the ability to wind down the trade early than the expiration? So that's also a very important consideration of your position. We also discussed price discovery. Price discovery in an OTC is difficult because it's a specific one-on-one transaction over the counter. On the other hand, ETFs have history. There is a clearinghouse, there are transactions that keep happening. So you have a backdrop here. In terms of transparency of fees, again, the same point. With OTCs, you can build in fees that are not transparent, that you cannot know in advance. With ETFs, that's not the case. It's out there and you know that what's the standard trade fee. Now this is a flip side. In terms of flexibility, OTC wins because in OTC you can structure a transaction to suit your needs. And then ETF, you can't. Okay. And in terms of minimum size constraints, both have minimum size requirements. So do take a look. Again, this was not, but the point is that the above points are actually more important, but there are minimum size constraints in both. Okay, let's get to the fun stuff. So we will discuss monetization first. And why are we going for a monetization strategy as opposed to an outright sale? Okay, now there are a number of reasons why monetization works. The first point is that the security market that this individual or this client is in has strict regulations. So for example, in the event of this client buying, you know about markets where if you buy more than 10% of a company, you have to do a lot of declaration. You have to probably buy more. If you buy over 25%, you have to buy a lot more stocks, which is mandatory acquisition. There are complications. So security markets can actually stop somebody from doing an outright sale. So from that perspective, monetization is a viable strategy. Lockdown periods, in the event that qualified investors, when they participate in an IPO, they have to wait a certain period before they can exit. If there is an investor with this situation who now needs liquidity, and because he can't sell, he can monetize. He can borrow against it. And third, and most importantly, in the event, well, this is very important for both private business equity and public holdings, that you want to retain control. Now, how will we tackle monetization? It's a two-stage process. The first process is to create the hedge. So we will create a hedge first, and then once we've created the hedge, we will borrow against it. Okay? So that's the two-stage process. The more perfect the hedge, so if it's 100% hedge of position that you've hedged the entire risk away, you can borrow up to 100%, which means higher LTV, which is the point here. So higher percentage of hedge, higher the LTV. LTV is loan to value. Okay, now we will look at 4 strategies of monetization. There are 4 types that are discussed in the curriculum. The first one is short sale against the box. Second is total return equity swap. Third is, well, options forward conversion. And the fourth is forward sale / futures. Okay. And the embedded case in the curriculum is that there is an investor who has 1 million shares of ABC Corporation, and one share is valued at $100. So the net worth of this portfolio is $100 million. And we will look at all 4 tools and their applicability on this case. Okay, let's look at short sale against the box. So you have a position of 100 million shares. So what you will do is to borrow 100 million shares and then short them. Okay. So you have a long stock and then you are taking a short position. What this does is, with risk, it cancels out the risk. So what you are left with is a risk-free position, which means that any economic risk, whether it is dividend, whether it is interest, is eliminated. And we all know that once you're sitting in a risk-free situation, you can earn a money market risk-free yield. Okay? So you can earn a risk-free return. Okay? Which is this. And then you can borrow against this position. Now, the final point here is, well, there's the mechanism which we just talked about. And the other point is that how does this compare with other strategies? So the first point is this is the cheapest option. And why is this the cheapest option? Is because there is no dealer involved. You will not need a dealer for this transaction. So that's why this is the cheapest option. Let's look at the next strategy. This is the total return equity swap. Okay, so the total return equity swap is actually very straightforward. This is where you have a portfolio which generates a return, you give that return to a counterparty, and the counterparty will give you a fixed or floating return. Okay, so most common example when we are studying swaps, whether it's level 1, 2 or 3, is that I can give my entire return, equity return, okay, equity return, I give it to party A, and what does he give back to me? He gives me LIBOR. So what have I done? I've created a hedge. Again, I've created a hedge. So what's my maximum benefit? It's LIBOR. So if my portfolio outperforms, great, I don't get it. I will only get LIBOR. Okay? Capital appreciation, dividends, everything goes to that. Because what are we talking about? We're talking about total return equity swap. So capital appreciation plus dividends. Okay? So we're talking about this. And the dealer pays LIBOR. We have a loss gain on either side, which is adjust. Please understand that we don't get LIBOR. We get LIBOR less dealer fees. So this is not the cheapest option. While this is similar to shorting against the box, but this is more expensive. It's still cheap. It's more expensive due to dealer. Okay. The third strategy is to use options. Putting it very simply, you buy a put and sell a call with the same strike price. So if you have a strike price of 50, if it goes up, or rather, well, it goes down. Let's talk about going down. Your put kicks in, right? But you sold the call, right? Then, and if it goes up, then the call is exercised. So again, this is a hedge. Since you've eliminated all downside risk essentially, again, we're talking about a risk-free situation. It's risk-free. So because it's risk-free, again, it can earn the risk-free rate, which is the money market yield, and which will have a high loan to value.
We've also capped the upside return.
We have also capped the upside return. Yes, indeed, because we sold the call. Right. Okay, let's talk about a forward sale then. Forward sale is a forward contract to sell the shares. Forward contract to sell the shares in future. Okay, so the price is known upfront, hence there is no upside or downside. Again, this is perfectly hedged. So you borrow against the position with a high loan to value. Okay. Now, important thing. These four strategies can be examined in a question, of course. And how do we rate them? By looking at the tax events. That could be one of the considerations that you need to look at. So, there are some countries where if you have a perfect hedge, it is treated as a sale and hence taxed. So, the idea is to create a hedge but not make it a taxable event. So, now there are these, I've gone through the curriculum and there are these key points that I can easily see in an exam question. And these points are, in fact, these are questions and then there are the answers. So, the first scenario is that should the gain from unwinding the hedge, should that gain be long term or short term? We know that if the gain is short term, means it can realize it's taxed. So from a tax efficiency angle, what do you prefer? long-term gain. Potential losses, two kinds of losses, unrealized, realized. Long-term losses, short-term losses. It's the entire opposite now. If you have a loss, take it now. Which means that we want short-term and deductible losses. It's not just short-term loss if it's not deductible. The third point is, if the contract is physically settled by share delivery, so this is an actual delivery that you are taking, then what do you want? Long-term gain. Again, with respect to gain, the fundamental point is should be long-term because you're looking at a tax-deferred scenario. With losses, they need to be deductible and they need to be short-term. What about the carrying cost of monetization? What about the interest expenses that you are incurring? They need to be deductible again. Okay. Should the hedge affect tax on dividends or interest income? The answer is it should have no impact on it. If there is an impact, it's most likely to be a negative impact. So what we prefer is no impact. It should not change our existing scenario. Okay? And in the curriculum, after this particular point, we have a slide which is a recap from reading 11, which is about the tax regimes. There are heavy capital gains, light capital gains. They've reproduced that table. Again, goes to show, and I want to keep reiterating it, tax is a fundamental driver of the last 3 readings. Let's continue. From monetization, we've moved on to hedging. Okay, so the first strategy is to purchase puts. What is the put option? It's an option to sell. So you have a long stock with a long put that serves as an insurance. And what is the benefit with options? When does a transaction happen? When the option is exercised, which means if it's out of the money. So even if you buy insurance, buy puts, and it does not come ever into the money, what happens? It goes to waste. What's the loss for you? What have you paid? The option premium. Okay. So, because if you want a put with a high exercise price, will it be cheap or will it be expensive? If it has a high exercise price for a put option to sell at a higher price, it should technically be more expensive. Expensive. Because the price is high. There is a put where I can sell for 50 and a put where I can sell for 100. Which should be more attractive to me? Exactly. Okay, so but how do you reduce the price of the put? Because these derivatives, these options can be very expensive. If there's a transaction which involves millions of pounds, then these options are not very cheap. So what you want to make sure is you want to optimize. Just because you want to hedge does not mean you incur a massive cost which actually results in no cost benefit to you. So what you can do is you can buy an option which is out of the money. Okay, so because out of the money it would be cheaper. The further away it is, the cheaper it should be. Options with lower maturity or a short maturity which will expire soon are also cheaper. What about zero cost collars? Zero cost collar is a collar that has no cost. No zero cost collar. Okay, so what happens? Well, should you say you retain the upside or you're protected from the downside? I think that's a better point. You're protected from the downside, and there's a tax deferral. Again, with options, when an option is exercised, only then there will be an event. There's a tax deferral here. Okay.
Are you sure that's true that you retain the upside? Or there has to be a cap on the upside?
There is some upside available on a zero cost collar, but the finer point, the larger point is you're protected from the downside. That's the main point. Okay. Now we move on to a prepaid variable forward. And how a prepaid variable forward, the curriculum has not spent a lot of time on this topic, but they're given two scenarios, very basic scenarios. So the point that you need to know is that this is economically similar to a collar plus a loan. So the client would buy a collar and then he would take out a loan. Okay? And based on this, so he's taking out a loan. So if the stock price is 45, you borrow today at 45. Okay? And in the event there is an upside, what happens then? So there is a range. So from 45 to 50, if the stock price moves from there, you're protected. Okay? But if it goes above 50, then you have to pay the lender the premium above 50. So what a prepaid variable forward does is it protects you within a range. Okay? When you're borrowing. So when you're repaying within a range, you're protected. Anything above, that's where you have to pay the premium. So that's the point of the prepaid variable forward. You can take a look at the example of Denton Corp. It has again 3 scenarios and you pick out one. It's a very straightforward example, so I'd like to move on to the next topic. Now with hedging, while we've discussed the strategies for hedging, we need to also again look at tax. So from here, what we're discussing is a tax mismatch. A scenario could be that gains, you could have a stock option. So you have stock options that are growing in value. Okay. So they're growing in value and those gains are being taxed as ordinary income. Okay. And capital losses on hedges or capital gains are taxed at 10%. Your ordinary income is taxed at 30%. And capital losses, when you incur on a hedge, they are not deductible because they can only be set off against capital gains. So if you have stock options and they're increasing and you have a tax on that gain, which is part of the ordinary income, stock options are usually part of your salary benefits. Okay? So when you have capital losses, you can only adjust capital losses through capital gains. So if you don't have a capital gain and you have capital losses and you're paying taxes on your ordinary income, that is what we call a tax mismatch. So strategies should be derived so that tax mismatch can be minimized. Okay? So the one way to go about it is to go for a yield enhancement with a covered call. Now, the fundamental point here is that there is a client who is looking to, again, diversify from his concentrated portfolio. Okay? So he has sold a call. When you sell a call, somebody is buying the call, which means that other person has the option to buy. So you become the seller. If I have a concentrated holding and I've sold the call, so I'm actually selling my stock. Okay? And there is a counterparty which is going to buy. So if my stock is worth 50 today and I have sold the option to sell it at 53 and then I received a premium of 2.98, this is an embedded example. This is my premium, right? So technically this is, one could say, an insurance as well, 2.98, because this is the premium that I have received. Okay. So what is the final point? Because he arrived at the sell option and the strike price has been ascertained, the owner has psychologically decided that 53 is his liquidation value. So he has mentally prepared himself to sell. So when there is a sell call, or he sold the call, he's actually mentally prepared himself to exit. And this option premium that he has received is the yield enhancement. Okay, so the 2 points here. The first point is that he has established the liquidation value, and the second point is he's protected against a downside of 2.98, which is the option premium that he has received. Okay, and given that he has sold a call, he has psychologically prepared himself to sell this concentrated holding. Also, when you sell a call, predominantly if an option has a stock has a sell call option on it, it will move within a range. So the owner will also see that the stock is moving within a range. Okay? Now, moving from hedging, let's look at equity strategies. Now, what we're talking about is, again, tax management. So what we're looking at is a tax mismatch. We're looking at tax events. How can we look at a return that is tax efficient? That means that if we are indexing to a market, we should generate a return that is better or equal to the market return. So this is what we call a hybrid. We've discussed index tracking before, which is indexing, where you buy the index. But for tax, we've added this angle of active management. But this active management is specific to the taxation. So when we receive the cash from the monetized position, we invest it in a diversified portfolio. And this portfolio is diversified to track the pre-tax return. But essentially what the portfolio manager is trying to do is to outperform the index on an after-tax basis. So there is indexing on a pre-tax return basis and active management to get a higher after-tax return. That's all they've explained. Okay. The second strategy is to look at a completeness portfolio. So this client has a concentrated holding of General Motors. So what he will do is to combine this portfolio, which is 60% of his holding, through a diversified holding of 40%, and he's going to float this portfolio around this concentrated portfolio to generate an alpha. Okay? So there is one concentrated risk, and to diversify the risk, you buy technically an uncorrelated portfolio, which means that the diversification benefits come through. Another strategy is to look at a cross hedge. If a hedging instrument is not available for the stock, or there are restrictions, so you can use a cross hedge. Cross hedge is never a perfect hedge, it's an imperfect hedge. So because you can't directly hedge, or if the hedge that you're hedging or executing is perfect and it's classified as a sale, you go for a cross hedge. So if you're long on a stock and you have it, so you short a stock in the same industry or another sector which is correlated, so you have a view. You can short an index, or you can purchase puts on concentrated positions. That means that if your stock goes down, you sell. But these are all cross hedges. That means you're not hedging that stock directly. Okay? You're not shorting the same stock. You're shorting another stock or another index. What are exchange funds? Exchange traded funds, ETFs. This is essentially, if there are 10 people who have concentrated holdings, they pool all of them up in one pool, and everybody comes up with a smaller percentage of a diversified concentrated portfolio. That's the exchange funds, and there are obviously tax benefits from this. Please do example 4 and 5. And now let's move on to managing concentrated positions in private business equity. This is the last section that we're doing for this reading. Now, this is a bit different from equity holdings. This is essentially 2 people, 3 people owning 100%. This is a private business. This is not a market business. So, hedging instruments that we've used for the market will not apply over here. So, there will be absolutely no relation to it. So, there will be, again, 3 strategies. One is an outright sell, one is monetize, and let's look at if there is hedging here. Okay, so how can business owners liquidate or monetize? First thing they can do is they can sell to a third party. Now, a third party could be a strategic buyer, could be a financial buyer, or could be what they classify as an other investor. They haven't mentioned what the other investor is, but there's an other investor as well. You could sell to the insider, which would mean sell to management. We've all heard of management buyouts. Sell to employees, ESOP, or transfer to next generation of family. You can recapitalize, which means the company buys the equity from the owner. You can have a divestiture of non-core assets. This happened in the case of ExxonMobil, which after it acquired ICI, went on a divestiture strategy for non-core assets. You could take out a personal line of credit against a company shares, so you pledge the shares, take out a line, that's monetization. Or you could do an IPO. Now, let's look at these options individually. Who are strategic buyers? Strategic buyers are people who are looking to maintain a long view on the company, and they would buy. So this is not a trading view, this is a long-term acquisition. And these buyers would pay the highest price, highest premium for an acquisition. The second category is financial buyers, which would include funds, private equity houses, which would buy with a view to sell later. So they have a 5-year, 7-year horizon, and they will exit. And while they will pay a premium, it will be lower than the strategic buyers. The third category is recapitalization, where the company is going to buy the owner's equity, and the company will be funded via the private equity house, and then the private equity house will be issued shares by the company. Okay? So this is the owner, this is the company, and then there is a private equity house or a financial buyer or a bank. Okay? So the owner gives the equity to the company, in fact sells it. And the company pays the owner after taking money from the private equity, and then the company issues shares to the private equity. Okay? And this is a phased exit. Why? Because the private equity owner or the financial buyer will at some point in time exit, and the owner will look at it, the subsequent acquisition at that point in time. So this is a phased exit. The other category is a management buyout. Management buyout predominantly are discounted. These are discounted acquisitions. In the event that management buyouts don't succeed, you may have a conflict with the owners. And in cases there are management buyout obligations whereby the existing management has to stay with the firm to run it and have the capability to grow it. We discussed, in fact, I broadly mentioned divestitures, which is sale of non-core assets. This can be a situation whereby you have assets that are not part of the company long-term strategy anymore. We have multiple examples where products are discontinued by big conglomerates and those products are then sold. So, you could take a look at the Clariant acquisition or ExxonMobil, a lot of examples. Gifting. Now, gifting this is not advisable. If the owner does not have a separate wealth, in the sense that if he gifts the business and that's it, then what? He's in trouble. Okay. What about a personal line of credit? So a lot of the times that individuals actually borrow by pledging their shares with the bank. It's a very common thing to do. And it works like a put option. It works like a mortgage. That if you don't honor the payback, they take your shares. So it's a put option. So basically you have an option to default. An IPO is a market-based exit, initial public offer. The problem with the IPO is that the IPO stipulates that the owner will continue to be with the firm. An IPO cannot be 100% divestment. So this is also a phased exit. IPOs are usually done to unlock the value of the business. So if somebody wants to sell their business at a high premium, they will first get it listed. They will list 20%, 30% of the company, and then they will subsequently, once the company has generated enough interest in the market, then they will exit. The key point is when a private business goes public, there is increased scrutiny. The last point here is an ESOP, which is an employee stock ownership plan. Again, you have the owner, which sells into a plan, pension plan, a trust, which is the ESOP, and this pays to the employees. There are cases when the ESOP can take debt. Okay? And the ESOP is also a phased exit. Please do examples 6 and 7. They're relatively straightforward. Let's have a quick recap of this reading. This reading is very challenging. So it's imperative to do the examples and end of chapter questions diligently. Thank you.